In this video, I'll help you decide if trading is right for you. We'll go through the risks, the pitfalls, and how to avoid losing all your money. If you're new here, I'm Nick, former investment analyst. I've traded Forex, stocks, commodities. I've used funded accounts. I've used automated trading algorithms and used a variety of different brokers. So let's start with what separates trading from investing. While both investing and trading will have a buyer and a seller, with investing, you're generally looking for the value of that instrument to go up over the long run and ride that up as future investors buy into it. Trading is more like poker. While some traders will do fundamental analysis, most will focus on technical analysis. They're assessing what they think other traders will do. They're less concerned with where they think the intrinsic value is going to be and more concerned about what the stock price is going to do in the short term. So it's much more psychological. It also adds into the mix leverage, which is essentially using borrowed funds to increase your returns. Of course, that also increases your risk. Around 85% of retail traders lose money in the long run. It's the psychology that destroys most accounts. To be a profitable trader, you need to have at least one of these metrics in your favor, and that is to have your winners bigger than your losers and to win more trades than you lose. The risk with the first one is loss aversion. So the temptation here will be to cut winning trades short for the fear of losing it. On the other side, losing trades are rarely cut short because you don't want to realize that loss and you hope that it reverses. A little bit like being pot committed in poker. On the winners versus losers, most traders will overtrade, looking for trades that aren't there. When you lose a trade, your immediate response is going to be to jump into another trade because you want to get it back. And this obviously leads to revenge trading. If you've placed a number of trades throughout the day and you get towards the end of the day and you're down on the day, well, you're not going to want to stop there because you don't want to finish the day on a loss. So you want to going to be looking for further trades because you want that to be a profitable day. But really then that changes your reason of why you're entering a trade, and then you're entering for the wrong reasons. You look for a trade that's not there and you're likely then obviously to lose it too. Account sizes play a massive role in the consistency with trading. For most people, when they start trading, they're looking to earn enough money to either live off, quit their job, or just improve their lifestyle. The problem here is that you start to become emotionally invested in the trade. You need them to win so badly. You start entering trades for the wrong reasons. And then that goes back to the previous point about when those then lose, you then start placing more and it just grows from there. It also encourages a level of impatience. The only way to not be emotionally invested in your trading is to trade with money that you're willing to lose, i.e. it's not going to affect your day-to-day life if you were to lose it all. This means you're starting off quite small or you're very wealthy already. The problem people find at the beginning is the trade-off between time and earnings. At the start, you need to spend a lot of time learning, developing the skills, the strategies to be a profitable trader, or while earning very little from it. This then causes people to either increase the risk or to overcommit the capital that they can afford to lose. And in both cases, you're going to increase your emotional attachment to it. What most traders then end up doing is turning to prop trading firms. So these are online companies that will offer trading capital once the trader can prove that they're profitable. They will offer challenges that the trader will pay to enter. These challenges will consist of specific criteria that they're looking for to determine if you're going to be profitable. Upon passing the challenge, the trader will then be given a predetermined amount to trade with, along with a specific profit share. On paper, these challenges look fairly straightforward, but in reality, they can be really hard to pass. There are very specific rules that need to be adhered to, and if not, then you fail the challenge, and in order to retake it, you have to pay again. Some of these rules will include limits on drawdown, both for the day and overall. They may limit what you can trade, and they may also stop you trading around specific news events. The challenge fees are how these companies earn their income. They calculate that the majority of traders will fail these challenges. These specific rules will also carry forward to your main account once you're funded as well. So even once past the challenge and you're given a funded account, if you fail any of these rules, then it will simply be taken away. And in order to get it back, you have to then complete another challenge again, which of course you need to pay for. Most people think in order to be a good trader, you have to be really good at technical analysis. You have to be able to spot patterns that others can't see. But in reality, this is about 20%. The majority comes down to the psychological element. It's the ability to emotionally detach yourself from what you're doing. You need to be able to establish a strategy and execute it without deviating from it, regardless of the circumstances. This is why trading bots can be so useful, because they simply just execute the plan. I know this video is being geared towards avoiding trading, and if you want to try it, you absolutely should. I just think it's really important to go into it open-minded and be aware of the risks. Don't see this as a get-rich-quick scheme, as much as the online gurus would like to tell you. Thanks for watching, guys. Like and subscribe, and I'll catch you in the next one.